All right, welcome back, guys. We are now going to talk about the third case, and this is going to build on some of the concepts that we've already discussed. So, if you will receive, let's say you have made an investment somewhere, and what this investment guarantees you is that 5 years from now, you will receive $1 million from this investment, right? And we don't know what is the interest that this investment is going to pay, and we don't have to. The factor that we need to consider over here is the discount rate, and that is given as 5%, right? So let me spend some time talking about what is a discount rate. So if you remember in the previous video, when we talked about the future value of the money, we agreed that the money that is worth $100 now is gonna be worth less than $100, as the years pass, right? Because of the inflation and so on and so forth. So the discount rate is really used to discount the future cash flow to the present value, right? So $1 million. So whatever you can buy in the $1 million 5 years from now, you will be able to afford the same thing with significantly less than $1 million, right? So that is the main concept of the discount rate. Now, if that is clear to you, you would always remember that higher the discount rate, lower will be the future value of the same money. Or when you have to bring the future amount to the present value, higher will be the discounting or smaller will be the amount, right? So that's the general sort of like construct of the discounting. So let's move forward with this example. Hopefully it will make much more sense, right? This concept is nothing but the present value of the money, building on what we talked about earlier, which was the future value of the money. This talks about the present value of the money, and the underlying crux of the topic over here is time value of the money. As the time passes, the value of the same cash flow keeps on diminishing. So let's say you have made certain investment in an annuity, right? And we'll be looking at those examples down the road as well. So, and it keeps on giving you $100 every month or every year. So the $100 that you're gonna get in the first year is valued more. $100 you're gonna get in the second year is valued less than this amount, and so on and so forth, right? So that's the main concept. And the same thought process is used in key financial analytics or valuation of the company when you're looking at the many, many years of cash flow of the company. And the name of the approach is discounted cash flow. So the cash flow which is going to be coming in the future has to be discounted to bring to the current value. I do have a couple of links that I have posted over here. One is obviously the wiki link that I have, and the other link is about an article that I have wrote on LinkedIn. So you can search for this article. It says feeling lost about your investment gains. Let's talk about the NPV IRR and more. This is on my LinkedIn post. If you just search for the article, you'll find it there, right? And I will come back to this particular article for the caselet 5, but something that you should keep in mind, that it is there. All the details are mentioned there as well, right? Okay, so now let's go back to where we were and step back into the presentation. So how would we do that, right? Very, very simple. And that's the beauty about whatever we are working on, that the actual math is not complex at all, right? So if you remember in the previous example, we did the future value dot simple. Now we are just reversing that. So we are saying that the discount rate that we're applying is 5%. Year or the period or the number of periods that we're looking at is 5 years. And the future value is gonna be $1 million, 1 million USD, right? So what is this money worth now? So I can bring it to the present value, and if I bring this $1 million to the present value, that turns out to be around 783k odd dollars. Now, what does it mean? It means that whatever you will be able to buy for $1 million from 5 years from now, you can buy the same thing at a significantly lower price, 783k dollars, right? Right now. So that is the value of the money that you're gonna get 5 years from now. Or in other words, if an investment is there which says, okay, you give me the same amount that you're going to invest now, and I will give you 784K immediately, that investment is going to be more worthwhile than putting the money in this, because even though you think that you're going to get $1 million, but that $1 million is worth 780K at the current time, right? So that is the main thought process. So, or you can think about, and I'm giving you a hint for your quiz as well, you can think about if you have two alternative investments and two different horizon, right? So investment A, investment B, 5 years down the road there's going to be certain value, 4 year down the road there's going to be certain value. I can bring them back to the present value and then make the apple to apple comparison, and whichever investment is valued higher at present will be a better investment, right? So I think, I mean, that gives you some data points to handle the quiz as well. So let's do this very quickly in R. This is the case 3, and again the code is very simple and straightforward. So pv.simple, 5% discount rate, 5 years of tenure, and $1 million of return that we're gonna get of the future value. I want to find the present value of that, right? So in order to get $1 million from now, from 5 years from now, you have to invest 783K dollars, right? And this can also be used in cases like future planning, right? So if you have to plan for the education of your kids, or the marriage, or if you want to buy a car 2 years down the road, or if you want to plan for the retirement, and if you have figured out this is the amount of money that you need to really have at the time of the retirement, it basically tells you the math in terms of, how much is the amount that you have to invest now to get that amount at the retirement, right? So hopefully that give you a sense of what we're talking about. So now let me step back into the presentation and talk about the quiz 3, which is exactly what I've told you. But let me just try to build a little bit more clarity over here. So you have two funds, and the fund A will give you $1 million 5 years from now. Fund B will give $1.1 million 7 years from now, right? The question is which fund you should invest in, and you can assume a 4% discount rate for both of these funds, right? Should you invest in fund A or should you invest in fund B? Obviously, fund B is giving you higher amount, but the duration is longer, and fund A is giving you smaller amount but shorter duration. That is the question for you: which fund you should invest in? And that's the end of case 3. I will meet you again in case 4. Thank you.